Well, there's a very interesting input which has just come in moments back. SkyMet, one of the weather agencies, have just come out and said that there's very high degree of probability that it would be a normal monsoon in 2021. And guess what? M&M is gaining 7% in trade. That's the best performing stock as far as the index is concerned. Some of the damage done to the financials yesterday on fears of economic impact of COVID in key cities, all of that is also getting reversed. But net, it's a narrow range. That's what the market is looking like right now. Let's see how it goes from here on. Let's analyze the way forward and what should be your portfolio approach. If you could take any cues from the ultra high net worth individual community, how they are positioned. We've got a special voice who tracks that space very closely, apart from working closely with family office community as well. In fact, in the last couple of months and quarters, family office as a space is becoming quite influential as far as the investing ecosystem is concerned, both for listed as well as unlisted space. Narayan Shroff of Barclays is joining us today to discuss more. Narayan, good afternoon. Thank you so much for your time. Before we begin about markets and your strategy, what you're talking to about your clients about, this input, a normal monsoon, third year in a row, if it is normal, SkyMet says high probability that it will be a normal one. Do you think that this could be able to cushion the blow of a second wave, which is playing out, and it did manage to scare the market to a certain degree as well yesterday? If indeed a normal monsoon this time as well, it may kind of even out some of the losses. Would that be a probability?
No, definitely. I mean, monsoon, if you look at it, monsoon is also, just one of the variables, and it's good to have it as a positive variable. The way I look at it, when you look at from a second wave impact perspective, I look at it that there are two camps. There is an optimistic camp, and then there is a cautious camp. And we will keep toggling, especially as we get into second wave, we will keep toggling between the two. Of course, just about a week back, we were talking about, inflation and tapering, being one of the cautious stance, coming up in the medium term. To that extent, the monsoon helps in terms of food price inflation, which has been seeing some tailwind from global pressures. So that is going to be positive. But the way I would like to divide this debate around the second wave and the impact is to slightly look at in a longer term perspective. I mean, if we compare with last year, and if we break it down into three panes, the first one would be health and science part of it. The second one would be the economic activities, and the third one would be the financial markets. And we break it down into the points into optimistic as well as on the cautious camps. We will see that the optimistic camp would tends to have a larger weight, and that's what our analysis says. So, for example, in health and science, we've had multiple vaccines coming up, and we have new ones getting approved as well. We've tested now the medicines and equipments. We've got the healthcare and frontline workers which are vaccinated and ready. And then in terms of statistics, I mean, if you look at it, we've got 12 crore plus recovered cases in the country, plus the unreported cases. And if you add to that, the asymptomatic situations, and then if you add to that about another 10 crore plus cumulative vaccinated cases, I mean, in a few days, we would be counting about, 20% of the total population. So we have to look at the fact that the vaccine is, number of vaccinations are actually growing at a logarithmic pace compared to the number of new cases. It's almost like 1:20 or 1:25. And also that, basically the vaccine take up, which was a big concern some time back, has been good in the country. We've in fact, on the other side, are now talking about shortages. So that take up has been really good, considering our size and distribution strength there. Orderly compliance with self-quarantining, I mean, as compared to last year. So all these we have to compare with the last year. And at the end of the day, the death rates are low. Not to say that every death counts and it's tragic, but then the rates overall have been low and mostly involves comorbids. Now, let's move to the cautious stance. There you have the vaccine efficacies being questioned. There's questions around how long would the vaccine effect last. There is also about variants and mutations of the virus itself, the vaccine shortages that we've talked about, and the plans around that, delays and logjams in testing that recently we've seen, as well as in treatment. Also, globally, vaccine scares like we've seen in Europe with blood clotting and other issues. I mean, all this may hamper, but then again, if we weigh between the optimistic and caution, I would say that more optimistic compared to last year. Economic activities, again, lockdowns are expected to be more regional, and sparing the businesses. So more and more as the politicians, and policymakers at central as well as state level, they are cognizant of the fact that they need to allow more room for the businesses to function. More certainty is required. I think the biggest impact is not the lockdown. It is the uncertainty on what measures would be taken, how much the businessmen would be allowed to function, the shopkeepers would be allowed to function. So what would be those norms? If we have more clarity around that, that could be constructive as well. But people have found their way around employment and income visibility. That, according to me, is the biggest factor. All the sentiments get driven. And if you go back last year, that was the big one. People being uncertain about, whether they would have the employment, what levels of income would they have, and that drives consumption. That's dramatically come up from last year. People have seen the light at the end of the tunnel, and that's very critical, right? So, also we've seen the policies, and policies are no longer, short term. There is a larger visibility. You have a fiscal expansion plan which spans out 5 years. We've got RBI coming up with policies and growth, accommodative outlook for a longer period. So these policies, again, global revival
if I could just
is now
come in over there.
Yeah.
Right. Narayan, if you could just come in over there, assuming that earnings trajectory continues to remain upward for the next 2 to 3 years, that's what the estimates show, and inflation remains in this narrow range, which RBI too has spoken about. What kind of hypothesis on risky assets are you recommending your ultra high net worth individual clients and family offices should? What kind of constructive weightage do they have on equities? And within that, some broad ownership, if you could share, the tilt is towards large caps or mid caps?
Yeah, so we see that tilting more towards the risk appetite definitely seems to be improving, and we've seen that in the market valuations as well. We've seen the mid and small caps outperforming over the last 6 months, and so we see recently, till the second wave caution came in, we saw that rotation towards cyclical as well coming in. But then the way, again, I would step back and from, again, family offices, large institutional and ultra high net worth investors, when they look at things, they have to go beyond what the market is telling them right now. They have a visibility and a patience to think through from a next 2 to 3 years. And if I was to maybe pin down into broad long-term trends and themes, and when I say long-term, it can toggle between 1 year to 5 year themes which are emerging and where the money is flowing. The first theme is basically that the rates are structurally coming down in the country. What I mean is RBI governor made that post-policy speech statement where he mentioned that from January 2012 to September 2016, the average inflation was 7.3. It came down to 3.8 in the period subsequent, which is from October 16 to Feb 20. I mean, that's a 350 basis point drop in average inflation. Yes, the last 1 year is a higher inflation. We can debate about the supply side and other bottlenecks. But then it is a 350 basis point drop. Now, give and take, even if the inflation, as you said, remains stable or starts to inch up, the fact is that overall, the opportunity cost, the rates in India has come down dramatically over long periods of time and should be there with the RBI's tolerance zone also anchored around 4% plus minus 2%. So, this was the last 5 years policy, and despite market, contemplation, it still has been now replicated for the next 5 years. So we are talking about, for a decade long of 4 plus minus 2%, and this directly impacts the rates in the market as well. And therefore, the investors need to be, cognizant about these lower opportunity costs, and they should bring down their expectations of returns from various asset classes. And what we've seen is that initially there is a defiance, right? So the investors would come back and say that, if you are investing in equity, if you are investing in small cap, I mean, my expectations would be 15, 20%, and so on. It needs to come down by 300, 400 basis points. And once you start, and same is with the case with debt, when the chase for yield happens, you have to accept. So I think that acceptance is coming, that one has to live with the lower absolute returns. And that is very critical. But if you do not accept it, if you wait for those levels, they may never come and you may miss the bus. So that's the first one. The second is that the duration of risk, if I was to take a bond market analogy, the duration of risk is going high. Now, what do I mean by that? Is basically if you look at all the forecasts and all the forward guidance which is coming in, start with globally the central banks, they are taking long-term views on the rates and accommodation. The government of India, again, as I said, 5-year fiscal plan, expansion plan. So these are long-term views. RBI's forward guidance, as I mentioned. Again, companies are giving longer-term earnings visibility to try and lower capital. Analysts have to take forward guidance beyond 1 year, 2 year to be able to justify valuations. But this is bound to happen. What it means from a portfolio construction perspective is that the duration of risk is going high. And risk is both sides, right? So if the forecast was, the realities were lower than or higher than forecast, both sides you carry the risk. So a fiscal deficit, if the government undershoots, brilliant. Positive multiplied by 5 years. If it overshoots, it's negative multiplied by 5 years. So you need to understand that the risk duration is going up. The third one, of course, is in terms of broad is quality. Now, quality is being talked about, and people often confuse quality with growth and value debate. Quality is a filter. It applies right across all styles and all market caps, and it is here to stay, and it will command a premium. Why? Because you've tested. Quality has been tested. It has been seen in the last 12 months more so than ever. People have tested their business continuity plans, BCP plans. They've tested the resilience, and they've seen that how these quality companies are not just able to acquire market share, not just able to, and more importantly, in the inflationary scenario, again, these are the companies who will be able to protect their margins because they should have the pricing power to be able to absorb those inflationary risks. So quality is here to stay and will command a premium. And again, when I say quality, it's not just in terms of equity, also in terms of debt. The next one is that in the short term, over the next 2 to 3 years now, some of the themes that we are playing in terms of strategy is, of course, cyclicals, as you said. So cyclicals are bound to perform because of, inflationary cycle coming in after about maybe 7-8 years. We have seen these cyclicals, especially to start with, the metals, cement, some of the engineering goods, FMEG, fast-moving engineering goods. I mean, some of these sectors should do well to start with, but the cyclicals should play out over the next couple of years. And similarly, in mid and small cap, the smaller businesses have suffered a lot some more bumps coming up in the second wave. But then if one was to look at from a next 2 years perspective, absolutely they should continue to outperform. And so a preference towards cyclical and mid and small cap continues to be there. Of course, just to complete the other one, which is there, is going to be technology, leads to productivity gains and the new normal. So technology definitely is there, both in private and public side. And of course, on the listed side, you've also got proxies to play technology on the private side. So I think these are the short-term themes. But then another risk area that is coming off the edges. 2018 was when we started with the IL&FS crisis. And then we've seen, even pre-pandemic, we've lived through that credit crisis one after the other in different formats. And so at this juncture, as the economy revives, and if you look at the risk premium or the spreads, the credit spreads, compared to the pre-crisis, the pre-credit crisis era, maybe just early 2018 perhaps, the credit spreads between GSECs and even AAA, AA and below corporate papers have dramatically gone up. And that makes it
Narayan,
a bit more
I'm sorry,
attractive.
I'll have to butt in over there. I take your point that investors will have to be extremely careful on the credit side as well. But we are completely running out of time. I need to take a short break here. Thank you so much for contributing to this chat today.